Hello everybody, welcome to today's webinar. I'm Terry Ryder, founder of Hotspotting, and today I'm speaking to Jason Paetow of AllianceCorp about a topic that speaks to the headlines that you as consumers are confronting on an almost daily basis about housing markets. We're going to discuss why the doomsday merchants always get it wrong and how property continues to make fools of those doomsday forecasters. Most of you, I'm sure, are aware of that media abounds with forecasts from the people I call the usual suspects about property values collapsing. But as we've seen repeatedly in the recent past, the predictions have little credibility. Bank economists and others regularly featured in mainstream media have woeful track records with forecasting future property price movements because they fail to understand real estate dynamics. So to achieve a more realistic and research-based appraisal of likely future events in Australian property markets, my guest presenter today is AllianceCorp Managing Director, Jason Paetow. Jason, welcome.
Thank you, Terry, and thank you for all the viewers that have joined us today. I'm looking forward to this session, Terry, because this is a topic that tends to really get under my skin. I've been in the property game now for well over 20 years. AllianceCorp has been around for 13 years now. And I've got to say, I've seen it firsthand. Particularly people looking to get into the market or novice investors wanting to, leverage off property. And because of some of these sensationalized reports that come out, they tend to procrastinate or they tend to get cold feet. And because of those decisions and because of some of the reporting that takes place, they miss out on huge opportunities. If we just have a look at the most recent property boom, on average median prices throughout Australia, a lot of people are looking at $200,000 plus gains, all right, in a very short space of period. So we see this all the time in the media, and I think it's important. And I think often when we talk to people, people realise that the media do sensationalise a lot of reporting. And while most people are sort of aware of it, when you're getting so much of it, and now it's all online, it's coming through your phone daily and things like that, it still tends to, put the fear of God sometimes into a lot of people that are looking to get into the market. And so, look, people just need to be really aware of why the media reports the way they do, and be wary that if they're to follow some of this reporting or make investment decisions based on some of this reporting, chances are, particularly if we look at some of the historical data, which we will today, that's a very costly mistake. And look, you've written a lot of articles on this as well. A lot of other commentators that we work with, also Dr. Andrew Wilson, who we speak with recently, talks about this a lot. And it's a real problem because depending on how the media decides to report on certain issues, can impact sentiment, which can impact our economy. But in this particular situation, it's impacting clients' investment decisions.
It is. And causing people to regret not making the decisions they were thinking of making. And I know you'll refer to this as you go through your presentation, but a couple of years ago when COVID first struck, we were having similar forecasts then to what we're having now in terms of major declines in property values, and people paused and said, we want to wait and see what happens. And those that didn't take the action they were planning to make at that time, as you've just pointed out, they missed out on potential gains of 100,000 to 200,000 by delaying decisions purely based on the white noise in the media.
Absolutely, and not just recently, but this has happened. We've probably been through about 3 or 4 cycles where I've seen this happen. I've had clients come to me, at some of our workshops and seminars and say, look, all the information you're presenting, Jason, is great, but we're probably just going to wait it out a little bit longer. And then I see these same people at some of our events a few years later, and they've come and spoken to me, and I've asked them the question, how did you go? Where are you at? How many properties did you purchase since we saw you last time? And their response is, oh, Jace, we're still waiting to see what happens. And I go, well, you've just seen what happened. We've just had this massive uptake, and now the market's sort of cooling off a little bit again. Like you're missing out on these opportunities. As we say to all the clients, if you're looking at a longer term strategy, it's time in the market, not necessarily timing of the market, and no one's got a crystal ball. I've got some slides here, Terry, so let's run through some of this information, and hopefully the viewers will see for themselves that you've got to be very cautious about what you what you read in the media. Okay, so I guess the role of the media obviously is to entertain, inform, and to cause debate. But as far as the media are concerned, any bad news is good news. And it's all about clickbait. And particularly if you look at social media and the online space and people competing for advertising, media reports and media advertising basically is funded through the advertising dollar. All right. So it's a race to who can grab the attention of the public, who can get those clicks on their articles or get them to the website. And unfortunately, this has created a situation where it's all about sensationalizing reports, right? So, when we think about our property markets, they follow a cycle, which we'll have a look at later. And for a lot of investors who've been investing a long time, understand these cycles. And it's perfectly normal that we go through situations where you'll see a bit of a boom taking place, the market will cool down, sit flat for a little while, take off again. There's markets within markets, different states take off at different times. We can have a look at all that. But I can't remember an article where, a commentator or, whoever's writing that article has put out a story to say, oh, look, just letting everyone know, yes, we've been through a bit of a boom, we're going through a bit of a correction, this is perfectly normal, this is what happens, go back and have a look at history. Nothing really to report here because no one wants to read it. You're only interested in the market's booming and you're going to miss out and create that FOMO and, read this, or you're going to miss out, or run to the hills, sell all your property, the market's going to crash, property prices are going to drop by 30 or 40%. Unfortunately, they're the only sorts of headlines when we talk about property that tend to get people's attention. But then when you actually have a look at what actually took place in the market, it pulls apart in terms of some of those forecasts, those projections, and some of that media hype. So, yeah,
Jason, it's really a question of emphasis and story selection by media, because the research that we do every day, and we're delving into online sources, newspapers online, Google alerts, we receive press releases from multiple sources every day. What we know to be true is there's actually a lot of commentators out there providing sensible, calm, rational, and quite moderate forecasting about what's going to happen with property prices. But they're not getting any airplay in media because media doesn't want to hear about that. They want to publish these sensational negatives. And the people who are willing to say prices are going to collapse are the ones that are getting the free publicity. And that's what it's all about. People are actually putting that material out to media because they know it will guarantee them free profile. And the people who are giving well thought out, well researched, moderate forecasting just aren't getting any airplay. And that's the problem.
Yeah, absolutely. Look, you only have to look at some of the most wealthy, profitable companies around the world, the Googles of the world, the Facebooks of the world. It's all off the back of advertising. So it is a bit of an issue. This is some of the articles that people would have been reading when we went through COVID. And look, yes, COVID was something that we'd never experienced before. We knew that there was going to be an impact globally to our economies. We knew that there was going to be an impact to the property markets. But back towards the end of 2019, going into early 2020, when this all started to come up, our markets still were fundamentally quite strong. But still, we had a lot of articles like this one, as you could see. House prices could fall by 32%. Again, the coronavirus pandemic, house prices to plummet 20%. So again, a lot of people reading this stuff are like, well, absolutely, I'm not going to invest in property at the moment based on some of this media coverage. Now, at the time, I tried to put out information again, and I regularly do this every time there's a change in our property cycles to again remind clients that this is normal. This is what the media does. It's not doom and gloom. It's the normal part of the property cycle. Yes, COVID did add another a layer to what typically tends to happen in our property markets, but everyone knew at the time it wasn't Armageddon. At some stage, we would find vaccines and we'd get back to a normal life. But then at the time, a lot of clients that we were talking to not only didn't want to purchase, they wanted to sell their properties. And so, as you can see from that video that I put out there, we had 800 views on that video, and hopefully some of the people that were watching that content said, yeah, you know what? There is going to be a bit of an impact here. It's not significant. I'm investing for the long term, which is really important, because in terms of trying to time the market or really understand where the market's at, if you are looking to buy and sell within a short period, it's critically important when you get into the market, because you're only going to be in the market for a short period. You might only be in there for a year or two and then want to get out. But that's, that's very sophisticated type investing. That's not something, sort of passive novice investors will embark on. It's very risky. But if you have a long-term view, any minor changes in the property market won't have a significant impact of the long-term gains that you hope to achieve over a horizon of, say, 7, 12 to 15 years. So again, I put out this content. This was during COVID. Luckily, a lot of our clients didn't sell. I can't think of a client that sold. And again, a lot of our clients continued to purchase during that period. Now, if you have a look at where we're actually at the moment, and here's an example, you can see here again, back in 2012, Professor Steve Keen put out some predictions that, again, the market was going to fall by 40%. And there's a lot of coverage. There's a lot of articles. Journalists jumped on the bandwagon, and there was a lot happening in the media. And of course, what happened? The market kept going up. Then, of course, we get 60 Minutes that love to come in and do these shows about doom and gloom. They did one back in 2016, again, predicting a 27% drop. They had all these, experts come online and sort of on the show and talk about, how it was doom and gloom. They did it again in 2018. They didn't learn from 2016 when the market again increased by 15%. They thought obviously they got a good viewership from the show in 2016, so they did it again in 2018. But this time they went as far as to say we're going to see drops of 40%. And of course, the market kept going up. And then, of course, you hit 2020, and then even the big banks at the time were talking about significant drops of anywhere between 20 to 30%, as you saw from the articles. And again, we've had a significant increase during the last boom nationally of about sort of 22 to 24% nationally. So if you think about some of those increases, at every point there, if you pay attention to some of these doom and gloom reports, you'll just never get ahead with your property portfolios. You'll always be kicking yourself that you didn't invest. And there's strategies out there that can allow you to buy properties that are either neutrally geared or cash flow positive. So even argument's sake, let's say you bought a property and it didn't grow in value and it actually pulled back in value. Big deal. This is normal. This is what happens. It doesn't change anything. It doesn't change your cash flows. You've just got a property there on paper that might be worth a little bit less. The rents are still the same, or the rents might even be going up. The cash flows are the same. All right. So it doesn't change anything in terms of your cash flows. It just means that you've got to be patient and wait for that property to come back a little bit. So it's not the end of the world when you have a property that corrects itself a little bit, which is a normal part of the property cycle, which we'll have a look at shortly.
Jason, a columnist that wrote a column in one of the major newspapers just in the last week were pointing out that the error in forecasting based on what was predicted around about March, April 2020 when COVID struck, in terms of economists forecasting a decline in property values compared with what the outcome was by the end of 2021, they got it wrong to the point of $3.8 trillion in terms of where values would have been if they'd been right with their forecast and where values actually ended up in Australia collectively. An error of $3.8 trillion.
Yes.
Yeah, and that was the...
All right. So and it just never ends, and this will always continue. And even now, at the moment, we see headlines like this. The Aussie housing crash is accelerating. What, I didn't know we were in a crash. All right, we've lost a few percent in some of the states. Some states are still in the positive. Okay, and you've got markets within markets, and we'll talk about that lately. But we've just come off an incredible boom where some of these states have seen increases of 20, 30, and even 40%. We'll have a look at the data shortly. So to lose a few percent here and there, how's that a housing crash? All right, so
yeah, the emotive language they use, they've run out of places to go when something, if a crash actually happened, they wouldn't have a word to describe it, because a drop of 2 or 3% in some markets is described as a crash or a collapse. So, you know, I come through newspaper journalism. That's how I started working life. And there was a time when we had quality media and we had tabloid media, but now, in my view, it's all tabloid media. They're all sensationalists. They're all going for that negative sensation headline. So we're seeing this kind of headline in the Australian Financial Review, which used to be the most serious and conservative of newspapers in Australia. And now it's a tabloid rag producing this kind of headline at a time when we've had a decline in some of the bigger cities, perhaps of 2 or 3%. And there was some very good research put out by the chief economist for for domain.com.au recently, which showed that over the past 30 years, the typical upcycle in Australia lasts 3 years and values on average rise 35%. The correction that follows lasts 6 or 7 months, and the decline in values on average is 3%. So that's the normal scenario. Values rise 35% over a period of years, then there's a small correction of about 3%, and then we get back to business.
Yeah, absolutely. And you've got to put it into proportion too. Like, you know, as I said, like for people who held on to property during our last property boom, some of their property values have gone up 20 or 30% on average, as I mentioned before, 200K on the median price nationally plus. Do you think they're really interested or really care about their property maybe dropping a couple of percent when they've made such significant gains? Like, you know, it's crazy. Yep. It's crazy. But, you know, a lot of people read this stuff and they think, oh no, this is bad. You know, the housing market is crashing. Or it could be someone looking to invest in property and they've had a friend or family member that's come across these headlines and advised them not to do it because, oh, don't you read the papers? There's a crash happening at the moment. You'd be crazy to invest in property. And then again, they put off their investment decisions and they regret it later. Again, downhill, major Aussie bank reveals grim property price prediction and crisis worsening. So, okay, so now we're in a crisis. So we're in a crash, we're in a crisis. It's just not reality. But again, people read this stuff and they don't move forward. This is reality. These are the facts. So with all these headlines that we're getting about property crashes and market drops of 20 and 30%, this is what actually happened. This is the pre-pandemic peak through April 22 recently. You know, you've got Sydney house prices there at 30%. You've got Melbourne at 13%. You've got Brisbane at 45%. You've got Adelaide 47%, Perth 25%, Hobart 37%. All right, so for some of those individuals that are in a position of purchase prior to COVID or even during COVID, they've incurred significant losses in terms of opportunity cost. And while we did have a few clients back then who did say, look, I'll probably just put things on hold for a little bit, we're coming back to them now, as we have been in the last sort of 6 to 12 months, and showing them the same sorts of areas and the same sorts of properties that they were considering previously, and they just can't believe it. They're just like, this is ridiculous. These properties are all overpriced. They're $100,000 more or $150,000 more than what they were earlier. Surely this can't be accurate. And we're like, well, that's what's happened. All right, the market took off. Like we had all this, that the markets were fundamentally strong going into COVID. Then we had all this pent-up demand where no sales activity was taking place, but people want to invest. You've got people saving during that period, so there's record savings. Then you've got the government coming in and also offering all these grants and the builders grants, again, which is adding fuel to the fire. And then, of course, the big one was a significant interest rate drop, which virtually we're paying hardly any interest. So you bring all that together, you've got a perfect storm. And then that's obviously what resulted in these significant increases over that period. So again, those individuals that paid attention to the media cost themselves hundreds and hundreds of thousands of dollars.
Yeah.
All right. Now, in terms of the property cycles, because clients often ask us, we're seeing a bit of a correction, we're seeing a bit of a downturn. Do I need to be concerned? And again, my answer to them, Terry, is what's your strategy? Are you trying to buy low and sell high within a short period? Are you trying to be a trader? Are you trying to make a quick buck? In that instance, yes, it's critical when you buy, it's critical when you sell. 99% of clients are going, no, I don't want to give up my day job. I don't want to quit my job to try to become a professional investor. I just want to do this passively while, to help myself pay off the mortgage or set myself up retirement or whatever. Okay, well, if your time horizon is long-term, the rule is you get into the market when you can next afford to, all right? Provided you've got the deposits, the bank will lend you the money. You've got a buffer in place, which we often talk about on our videos, etc., and you just get in and buy. It's perfectly normal. The markets have to go through these cycles. So typically, if we start with a downturn in the markets, so typically what we're looking at there is where you've just come out of a booming market. We've got a situation where developers have added a lot of stock to the market. The prices are getting up there. We've got some affordability issues. Rental yields aren't looking as high anymore because you've had all this capital growth, so it's not as attractive to investors. The market's starting to cool down. Buyers are starting to pull out. Banks are looking to start tightening up some of their policy, making it harder to lend because they can also see that a correction is coming. And you've got less buyers, but you've got all this stock coming on from all the developers and everything from the boom. So then naturally, the markets have got to take a bit of a breather, all right? So you tend to see a bit of a correction. But again, if you go back over history and you look at some of the graphs, it's never significant. It's not like the stock market, all right? Because the reality is that our property market fundamentally is one of the safest asset classes you can invest in because it's one of the only asset classes where the actual product, being property, is essential to everyone. We all need a roof over our heads. We all need shelter. It's not like the stock market where you can just sell everything or not invest in consumable, not buy consumables and things like that, which affect company performance. When it comes to property, we all need to live somewhere. So yes, we see some minor corrections. And does it impact people's portfolios significantly? No, as I said before, on paper, your property might just be worth a little bit less. It doesn't affect the cash flows and things like that. Now, over time, we then tend to move into a stagnation phase where the market's just sitting flat now. So it may have pulled back a little bit. We've got some property sitting there. We might still have a little bit of an oversupply. It's going to take a little bit of time for some of that, oversupply to be absorbed by the market. But eventually, over time, we start to see some movement back in the market. We've got a lot of people that are renting and their rents might be going up and they're starting to think, oh, look, rents are still quite expensive. Maybe we'll return back to the property market. Affordability tends to improve a little bit. And then we start to get some activity and some more sales occurring. And then that starts to build. And now we start to move into an upturn phase where we're starting to see some activity. People are moving in the market. The developers are starting to get more active and starting to put out more building approvals, etc. And then the market really starts to take off. And then again, you see all this sensationalized reporting about the market booming and all this sort of stuff that sometimes is over the top, as it is when the market is going through a slight correction. It's all doom and gloom. And then again, you've got the FOMO. So there's this frantic buying out there. A lot of people will pay whatever they can. Everyone's competing at auction. No one wants to miss out. But again, then the market sort of peaks, all right? And then we just keep going around in that cycle. And look, it's not a perfect science in terms of how the cycles work. In some of the metro areas, it can run from anywhere between 7 to 10 years. Some of the regional areas, sometimes it can be a longer, and it's not always perfect in terms of how it works. And you've got different markets with the different states. So sometimes you've got sort of markets within markets, as we'll see some from data earlier, but it's not something that long-term investors should be concerned about. And you can't pick it. No one's got a crystal ball to know exactly what the property market's doing. So as I say to the clients, look, if you can't pick it, if you can't forecast it, don't worry about it. Just invest when you can next afford to, but certainly be aware of what the markets are doing nationally. And if there's some good data, or if you're reading Terry's reports, and Terry's got some good data there on a particular state or region that is likely to do well then obviously, yes, you can certainly decide where to buy based on the information that you have, but certainly don't hold off your investment strategy. Would you agree, Terry?
Absolutely. And it also relates to the reality that we don't have a single market in Australia, and we don't usually have all of the country doing the same thing at the same time. Different parts of the country at different points of the cycle that you've just described. So I don't think I've ever seen, in all the years that I've been researching and writing about real estate, I've never seen an instance when the whole country was doing the same thing at the same time, all growing at the same time, all growing at the same rate, or all falling at the same time. So right now, while media is talking about decline as if it's happening across the country, we still have markets that are strong. We still have markets where prices are rising and sales activity is rising. And the key for investors right now is to target those growth markets. I often get asked the question, is now a good time to buy real estate? And I say it's the wrong question. The right question is, where is it a good time to buy real estate? Because there's always somewhere in Australia, this vast nation, where the growth drivers are in place for short-term growth as well as long-term growth.
Absolutely. And your comments there are in line with the slide that we have here in front of us. This is 2021. It just gives viewers an example. As we said before, not all our markets and not all the states operate in unison with regards to those property cycles. So this is why diversification is super important. Now, in our business, we buy established properties, we buy new properties for our clients, and we target all the different states. We buy in metro, we buy in regional. And one of the reasons why we do that is often sometimes we'll have clients that come to us that have a home in a particular area and only want to buy local because they know that area. And as we say to them, when we do eventually go through that cycle and you potentially see a bit of a correction in that particular region, you can't pull any equity out of your properties to continue to build buy more properties. If you diversify, you'll find in your portfolio, some years one state will go up more and you're kicking yourself, and often clients complain to us. They go, I wish we had bought more in, say, Queensland, because Queensland's just gone up. I go, be patient. Your property in WA or Adelaide or Melbourne, just give it time. And guess what? Brisbane will slow down, and then one of the other states take off. So they all tend to operate on different cycles. Here's another example. This is going back to 1970. You again can see the coloured lines there represent all the different states. The bar graph at the bottom represents, interest rates, inflation, things like that. And look, these are all things we can't control. We can't control what interest rates are going to do and how that impacts the market. Inflation, as you can see from the grayed out areas, we've got our recessions. We've got the GFC, we've got COVID. And again, it just demonstrates how resilient property is, that with all these economic crises that we tend to experience and the impact of interest rates, property over time consistently tends to follow that upward trend. And you can sort of see the cycles in the lines there, where we go through a bit of a boom, the markets might correct a little bit and take off a bit. But again, provided you've got a long-term strategy, you're going to fare pretty well. And as I mentioned before, even if you go through a slight correction there, sometimes your values on paper might adjust downward slightly. It doesn't have a fundamental impact to your cash flows on your portfolio or anything like that. So again, we've got to be careful here, because there's a lot of I could only imagine all the news reporting of all those events or all those negative events that took place back from 1970, and how many people, how many thousands or tens of thousands of people didn't buy property because of some of that reporting. And then looking at this graph here would have been kicking themselves.
I think, Jason, if you examine information like you've currently got on the screen and other analysis, I think there's a very strong argument that when we're in times of global or national turmoil economically, where there's major disruption happening, such as the global financial crisis, such as COVID, that's when real estate thrives. That's when real estate is at its best, because in times of disruption, people retreat to the security and solidity of bricks and mortar. I think there's a very strong argument for that. And when the share market did one of its spectacular collapses in the last week or so, I thought, well, that's probably good for real estate at the moment, because real estate doesn't do that. Despite the forecast telling us it's going to happen, 40% drops, it never happens. Real estate has that solidity that people can depend on. So when we're in times of adversity and disruption and fear, that's when I think real estate is at its strongest. So I think it's one of the key reasons that we've seen the boom that we've had in the last couple of years during these really difficult economic times.
Absolutely. All right, and look, another thing that we could just extend on a little bit more is, and we've touched on this a bit, is it's absolutely timing the market versus timing the market. As I mentioned before, no one has a crystal ball. We can't actually 100% forecast what's going to happen. It's only very important to property traders, people who are looking to trade over those short terms. The reality is, and we say this to all of our clients, if you've got the deposit, if the bank's going to lend you the money, you know, you go out and purchase. And as Terry said, there's always a market somewhere that offers opportunity to us. Particularly in this day and age, like many years ago, it was a lot harder for people to invest all over Australia. We didn't have the internet, so you couldn't just jump on realestate.com. You didn't have, you know, Google and all these platforms to provide all this research and data. But now we can. Now we can comfortably purchase in all corners of Australia quite comfortably. We've got people like groups like ourselves, buyers advocates on the ground that can do all the research for you. So there's no excuse for investors to say, well, look, I'd love to invest in, say, Brisbane or Queensland or Perth or Adelaide because I can see that the data is strong, but I don't know the area and all this sort of stuff. Well, it's no different than investing in shares or I often ask clients, where's your money invested at the moment that you have in super? And most people wouldn't have a clue. And I said, well, you've got hundreds of thousands of there being invested on your behalf in companies that you're not even familiar with. You don't get emotional when it comes to investing in property unless it's for your home, all right? Unless you're buying a home, you're not going to live there. It's just a neatly packed pile of bricks, all right? So if a particular region or area abroad is looking like it's going to provide a good return, well, then that's what we're going for, because we're just after the numbers. I don't care what the tiles look like in the house. I don't care, you know, what the place looks like and all this sort of stuff. All I'm interested in is, what are the figures telling me? You know, can I get it for a good price? You know, can I rent it out for a good solid return? What's the capital growth look like? It's just really, it's all about the figures. And certainly when it comes to building a portfolio, you're not going to achieve significant financial goals by owning one investment property. You have to have a strategy that allows you to build a portfolio over time. So that means that after your first one, as soon as you're ready to go again on the second one, you get the second one. As soon as you're ready to go on the third, you go. You're not trying to pick the markets. And certainly there's markets all over Australia that you can choose from. In terms of those markets within markets, here's an example of sort of what Terry and I are talking about. When we talk about our property markets, looking at some of the major capital cities around Australia and some of the price points, there's a big difference in terms of, you know, what these properties are costing. Obviously, properties within the inner areas, more established areas, you know, you tend to have much higher prices. There's obviously ever increasing demand. There's a limit on supply in some of these areas, and obviously some of these areas tend to have very good infrastructure and amenities and all the rest of it. So what you tend to find is also when the media are talking about some of these price fluctuations, sometimes they might be referring to different segments of the market. So for example, as you can see here, your more expensive properties tend to fluctuate more when there's a correction. So equally, if the market is going through a bit of a correction, your more expensive multi-million-dollar properties tend to see a more significant move in price. You know, and this has a lot to do with affordability, or if interest rates are impacting that, you know, an interest or a repayment on a multi-million-dollar loan or home loan is obviously going to have a much more significant impact than, say, a $300,000 home loan in one of these outer regions. So when we look at some of that data that's being presented, and there could be some data there that says, say, oh, property prices have dropped by 5% or 10%. That doesn't mean all properties have. You'll have some properties that may have dropped by 5%, some may have dropped by 10, some may have dropped by nothing, some may have actually gone up in value, depending on where you look in these markets. So in our business, we tend to help a lot of middle income Australia, help people get into the market. So we're usually targeting more affordable properties. So our purchase prices for established properties will go as low as the low 300s, so, you know, around the 320, 330, right up to about sort of 800,000. That's what we sort of look at, depending on where the client's at, what the strategy is that we're putting forward. But as you can see here, and highlighted by these coloured areas, and this is just showing some of the changes that we're experiencing at the moment, all regions impacted differently in terms of those property prices. Now, this is a really good graph here that sort of highlights it as well. This is going back 3 months from August. You can see here Sydney's going through a correction, but you can see here it's the more expensive properties. So the properties in the top 25% are having a much more significant impact than, say, the more affordable properties. And that's a common theme, as I mentioned earlier. The more, if you do want a more sort of conservative approach, or you do have some concerns about any changes in your values with regards to the property cycle, well, then you might be better off targeting some properties that are a little bit more affordable and diversifying your portfolio. Because as you can see consistently, same with Melbourne, the more affordable properties have seen very little change in their values. Some of the more expensive properties in the inner suburbs, the multi-million-dollar properties, etc., have seen more. Brisbane's seen a bit of correction. As you can see, the more affordable properties again do quite well, because again, when they're at those lower price points, even when there's changes in the market, we're seeing higher interest rates. Again, it doesn't impact those people as much when their liabilities or their loans on those more affordable properties are quite small. Adelaide, as you can see, hasn't really seen a correction there in terms of the more affordable properties. Perth is still in the positive. Hobart's dropped a little bit. Darwin is still in the positive, and ACT's come down. So the reality is the majority of our clients, even now, most of those clients, a lot of them haven't even seen much of a correction at all in their property prices, because they've gone into the market at a very affordable price point.
Yeah, I think that's one of the themes in real estate across Australia at the moment, Jason. We've just done our quarterly analysis of the entire country. And one of the themes that stands out for us is that people are chasing affordability in the affordable areas, and pretty much all the major cities of Australia are still strong. They've still got good sales activity. Prices are holding up in most of the cities in the more affordable areas. And your graph actually shows that very well.
Absolutely, absolutely. So look, some of the areas, if there are some clients out there and they are struggling to think about, well, where do I get into the market? I've been looking at the market for the last few years, and I have seen the massive surge in prices. Does that mean I've missed out? Can I not get into the market now? There's still plenty of areas. Again, we look at all the areas across Australia, but Western Australia is still a place that we look at in Rockingham. And I'll probably hand this over to you, Terry, because you are the location expert that we rely on a lot for a lot of our data, even though we also have our external team as well. But tell us a little bit about Rockingham.
Yeah, I think it's a very key part of the Perth market. It's very much on trend to be highlighting the Rockingham precinct. Perth is still a strong market. Sales activity is rising still strongly in Perth, underpinned by a strong state economy. But it's the more affordable end of the market that's leading that strong Perth market. And Rockingham's a great example of it. Not many places in capital city Australia where you can buy in coastal suburbs in a major capital city in, say, the 400,000s. But in the Rockingham market, you can do that. What I like about Rockingham, apart from its affordability, is that it's very close to some very, very major employment zones. It's a bit of a fallacy that everyone works in the CBD. Even pre-COVID, that wasn't true. Probably the biggest employment zone anywhere in Perth is that Kwinana industrial precinct that's a little bit north of Rockingham. So a lot of the people who live in these suburbs in the local government area of Rockingham are actually working in those kind of precincts, which are close by. So it offers proximity to work, it offers a coastal lifestyle, it offers a great deal of affordability and good connectivity too, because you can jump on the train and be in the centre of Perth quite quickly if you need to go there.
Absolutely. So we tend to turn to Western Australia for that exact point. It's for affordability, where we've got clients that have got price points in around that sort of 500. You can still pick up some fantastic options there. Here's a townhouse. This was, this is about 12 to 13 years old. You can pick this up for $360,000. It's renting out for $450 a week. So fantastic yields on these properties. These properties are cash flow positive. Again, not too far from a major capital city, very close to the ocean there, the beach, and it's cash flow positive, currently $90 a week. So this would be a great entry point, particularly for a lot of those investors wanting to get into the market. Then, of course, there's Queensland, and an area in particular is Townsville. So you want to give us a bit of a wrap on Townsville, Terry?
Yeah, I like Townsville a lot. One of the things we always look for in an area we'll recommend is economic diversity, and Townsville's got that in spades. It's one of the strongest and most diverse regional economies anywhere in Australia. It's strong in 6 or 7 different sectors, and that gives an underlying strength to the Townsville property market because it creates jobs, and out of strong employment comes demand for real estate. Townsville's an affordable market. You can buy in good solid suburbs in the 300,000s, get rental yields 6% and above. Vacancies are very low, and it's a good one to consider.
Absolutely. So again, something typical that we might source there for a client. This is an established property. This one's probably roughly 10 years old. So you've still got a little bit of depreciation in some of those internal fittings and fixtures. But very affordable, 380,000, 4 bedrooms, two bathrooms, 2 car space there, as you can see. And again, renting out for the high 400s, which is again resulting in a cash flow positive property in a good region that's really starting to take off. So again, very affordable for people wanting to get into the market. Then, of course, just one more for the viewers. Back here in Victoria, so this is obviously where our head office is here in Melbourne, but the city of Hume is a great location, in particular Sunbury. We've been doing a lot in Sunbury. Sunbury's really taking off. Again, it's very close to Melbourne, but if you want to give just a bit of a rundown on Sunbury.
Yeah, look, I really like this part of the Melbourne market. That's very much, again, on trend. While overall sales activity is down a little bit this year in Melbourne, these are more affordable areas like the city of Hume in the north. That there's no downturn in sales activity. Most suburbs in this local government area still have rising sales activity and strong prices. And again, one of the things that I like about it is very close to where people might be working. There's a lot of jobs up in the north of Melbourne, sort of along the ring road, the major highways. There's massive warehousing, logistics type businesses up there. A lot of the fruit and vegetable markets have moved up there some years ago. So there's a lot of employment nodes which are important to people. People want to buy affordably, close to where they work and where their kids go to school. And that's actually got nothing to do with the Melbourne CBD at all. It's about areas like the city of Hume. It's also a place where the growth of Melbourne is sort of spilling beyond what used to be the traditional boundary of Melbourne. And this is one of the places where it's happening. Areas that were previously rural areas are becoming rural residential areas, and a lot of that is happening in the city. But so the big population growth is happening in the north of Melbourne.
Absolutely. So again, this is for a client that we might source. This would be a new property or an off-the-plan property. The advantage is there. It's just the high depreciation, stamp duty, concessions, strong rental yields because those properties are brand new, etc. Again, here's some townhouses with a purchase price of 600,000 with 4 bedrooms, 1 car space, as you can see there, with a tandem car space out the front, and 2 bathrooms there. So again, cash flow positive. All right, so at around $38 per week. Investors will find now that as interest rates continue to climb, and we're obviously looking at some continued increases. I guess what these sorts of properties also offer is that because they're more affordable and because the rental yields are quite strong, that when we do see higher interest rates rises, what often happens is these types of properties then end up having what we refer to as a neutral cash flow. The properties might not be generating cash flow positive income, but they're certainly not generating negative cash flows. Some of the challenges where you do target the more expensive properties, and particularly in some of the major capital cities, that the rental yields tend to be quite low. And even during low interest rate periods, some of these properties may have neutral cash flows. So the investor might look at that and go, well, that's okay. It's in a really good location. It's a bit pricey, but I can afford it. The bank will lend me the money. But then they sometimes get a bit of a shock when the interest rates increase or sort of normalize from where they've been in terms of historical lows. And now those neutrally geared properties might be costing $50, $100, $150 a week. Now, again, it's not a bad thing because we teach clients how to manage cash flows through what we call a master facility. So we'd have a separate account that manages cash flows with regards to portfolios, and sometimes in some years your portfolios will have cash flow positive income, other years it might be slightly negative. But the important thing to have is a master facility there that if we are going through high interest rate periods, that those negative cash flows can be drawn for what we call a buffer within these master facilities. So there's not a significant cost there in terms of out-of-pocket costs for investors wanting to hold on to those properties. So some of the other things to really point out too is that for us, when we're trying to assist clients when the market's booming, while sentiment is through the roof, making it very easy to sort of work with the clients and they're quite confident, it can be very challenging buying properties during that period. The buyers have no power when there's a boom. It's the vendors and the sellers have all the power. So it's very hard to negotiate. It's very hard to get good deals. If you're working or looking to purchase new or off the plan through builders and developers, trying to get some sort of incentives or anything like that, or any sort of upgrades in your builds and things like that, it's very difficult to do. But when the market cools off a little bit, the power shifts back to the buyers. So, and this is where, the real estate agents might be returning your calls as a buyer, or the builders and developers. It's a good place to be. So what it does provide is some opportunity for investors today to get out there and negotiate and push pretty hard on those vendors and push pretty hard on the builders and developers, because chances are you'll get access to opportunities and deals that otherwise wouldn't have been available 12 months ago. Less chance of overpaying for that property. So typically towards the end of a boom, we go through this frenzied buying period where people are just paying whatever they can. They're paying more than the property's worth just to secure that property, or that's certainly not going to take place during a time where the market is taking a bit of a breather. So that certainly creates a lot of opportunities for investors out there to pick up some really good deals. And as I said before, there's plenty of opportunities around Australia. We can get into some good solid markets. You can get in at a very affordable price point as well. For those viewers who are watching, and they might be thinking to themselves, well, that's great, but I'm still not quite there yet in terms of not having enough deposits and things like that. Well, we have programs too, an Investor Express program, where we actually work with you to help budget and help you get into a property, whether it's 12 months or 2 years, but help you fast track those strategies and certainly help to secure some discounts on these properties, because you're looking at every opportunity available to get into the market as quickly as you can. So there's plenty of opportunities out there, Terry. You just got to be conscious of the rubbish that some of the media puts out.
Look, I think it's a time of great opportunity for investors, for people who can tune out the media white noise, think and act independently. This fantastic opportunity, because as you pointed out, there's some heat come out of the market, less competitive. You can perhaps buy a little bit better than you might have 12 months ago, but also at a time when vacancies are incredibly low and rents are rising. So we've got these strongly rising rents compensating for interest rates that are a little bit higher than when they were. So it's quite an attractive equation for investors at the moment at a time of opportunity.
Absolutely, absolutely. Now, did you have, and look, this is quite a common statement. I don't know, a lot of viewers have seen this before. This is from Warren Buffett. Be fearful when markets get greedy, be greedy when markets get fearful. And it's so true. Like, by the time a lot of people end up following the herd, often we're at the tail end of an up cycle or a boom. All right, and you're coming in at the tail end. The reality is, as I said before, it's time in the market. We don't wait. The rule is, as long as you've got the deposits, as long as the bank will lend you the money, you just go out there and you invest, and you keep an open mind in terms of where to invest, which areas. And if you're not too sure, well, then you come in and you speak to a professional like ourselves, who can give you some guidance on all the different locations, along with Terry's reports, which provide very comprehensive write-ups of what's happening in the locations. And through our team of property wealth planners and buyers advocates, we're able to help you buy in all those various regions across Australia and help you build up that property portfolio.
Yeah, I don't think anyone ever got rich following the herd, Jason, but a lot of people have been very successful in life in various spheres, including Warren Buffett, currently on the screen. They've actually become wealthy by doing the opposite of what the herd is doing. So the ability to think and act independently and to perhaps run in the opposite direction to the herd is often a secret to success. I just want to urge people who are out there watching and listening that if you've got any questions, could you type them into the chat box or the Q&A panel? We've still got 10 or 15 minutes in which we can deal with some of your questions. So please, if you've got questions about the market or about location, please let's have them in the chat box or the Q&A panel.
Absolutely. All right. So, and just reminding viewers too, as I mentioned earlier, Terry, for those viewers who are sort of thinking about taking a closer look at some of these opportunities, we are offering a complimentary strategy session. So in the notes, in the comments section there, one of the team will put in a link there. In terms of the team, we've got close to 50 staff here. We've got our main office here in Melbourne, and we've got offices up the East Coast, but we do specialise in educating people on the property market, providing advice and education around how to structure the finance, set up these massive facilities that I was referring to earlier, and then having a look at sort of what type of properties are best suited to them building their portfolio to achieve whatever financial goals they have in place. So should we be buying established properties? Where do we buy these established properties? What price points? Or do we target new properties? Or do we target off the plan properties? How many properties can we purchase over what time frame? And then most importantly, what we do is we make sure that we continually have portfolio reviews with the clients every 6 to 12 months and help them get into that next property, and that next property. So this is a complimentary session. It's normally valued at $500, but it's complimentary to any of the viewers. So if any of the viewers want to come in, hopefully we've got some questions there that we can sort of deal with as well. But if you do want to come in and get a complimentary, what we call a property wealth plan provided to you, the team will be happy to do that for you.
Okay, and I'll just remind people, to anyone who's registered for this event today will receive a recording, and when we send that recording out to people in the next 24 hours, we will include the link there, so you can click on that link and access the information to secure a free strategy session. We do have some questions. James' comment: the federal government has announced increased migration. Which markets will benefit most? And he's always asking whether Western Australia will get some benefit from that. I think it's interesting that at a time when we have record low vacancies and a bit of a rental shortage crisis, the government is actually talking about increasing the migrant intake without asking the question where they're all going to live. It's going to place even more pressure on rental markets, which is an even more favourable equation for property investors. But I think the migration initially will be going to the biggest cities, I think. Jason, what do you think?
Yeah, absolutely. It tends to filter through Sydney, and then usually starts in Sydney, then filters through to Melbourne, and then we get some more people moving up the East Coast. We do have some trickle through to Perth as well. But look, one of the arguments with Perth has always been that while it's this beautiful city, anyone that's been there, we'd all agree it's a beautiful city, and the ocean and everything's fantastic, but it just doesn't seem to have the same sort of population drivers that some of the major capital cities do up the east coast. But again, if you look at affordability, one of the most attractive things about Perth is that affordability. Price point in terms of getting into the market, and those higher rental yields because of that. But absolutely, what tends to happen, people migrating to the country, they tend to rent for the first year or two to get themselves settled, to work out exactly what they're going to do, and then obviously they start investing in property themselves. So absolutely, that's going to have a significant impact again, and it's very positive for our markets. We tend to open up our doors more quickly than some of the other countries, in particular New Zealand. They're way behind us in terms of allowing the migrants back into the country. But again, all that sort of lends itself to a solid recovery. And from our estimates and a lot of the sort of research and data, we're thinking sort of midway through next year, we're going to start to see a real bit of a shift in terms of the markets. yeah, sure, there's a slight correction happening at the moment, but we should start to see that sort of subside going into the first and second quarter of next year.
Sid's asking what we think the fundamental reasons for Adelaide's recent growth and the positive growth forecast for the future. What are your feelings about Adelaide?
Yeah, look, Adelaide's also been an interesting one for us. Adelaide's funny because the city of churches, there's nothing ever really anything exciting about Adelaide. It's one of those capital cities that sort of just prods along and does its thing. Like if you have a look at the sorts of returns, they're pretty consistent over time. They don't tend to have these massive swings that get reported on, whether it's Sydney or Melbourne or even Queensland, but they do have consistent growth. And again, it's affordability. Adelaide is still a much more affordable option than Melbourne, Sydney, or Brisbane, and the yields are still quite strong. So it doesn't often come onto the radar. It's not written about much in the media and a lot of investment mags and reports. But we invest heavily in Adelaide with all of our clients. But as we say to all the clients, it's all part of a diversified portfolio. So it's very rare that we'll end up buying, the same sorts of properties in the same location for the one client. They'll often have properties spread out and a diversified portfolio across Australia.
Yeah. But I think Adelaide's a great opportunity, and I've certainly been advocating it for the last couple of years. One of the things that is exciting about Adelaide is it's made itself the kind of the Silicon Valley of Australia, the high-tech innovation capital, and that's one of the reasons why its economy has become much stronger and created a lot more jobs. And it's interesting how many significant businesses, both national and international businesses, have set up the Australian headquarters in Adelaide because they're in that high-tech innovation space. So that's one of the things that's really pumping up the Adelaide market. I think we'll do in the future because the world increasingly is running on technology, and Adelaide's leading the country on that. Also, it's the national leader for alternative energy, which is becoming big business around the country. Let's see. David is asking whether we have some comments about the relative strengths of Greater Adelaide versus Greater Perth. Personally, I think both, there's a strong argument for both. Do you have a personal preference, Jason?
Look, not really, but it is interesting when we recommend locations to clients, because for us, we're not biased in any way. The relationship we have with our clients is for life, because the membership program is a lifetime program, and they keep coming back every year for portfolio reviews. So really, we're just about returns. We're just about the figures, because obviously when we do our portfolio reviews, we want to have some good news for the clients to demonstrate the performance of their properties. But still, clients will still purchase with emotion. And I guess the thing that we find often when we present different locations is, I guess, one of the big draw cards when you look at Perth, particularly when we're looking up the north and south coast, is just how close you can invest to the coastline. And when we show examples of properties to clients in the various states, often they tend to gravitate to those areas also where they could imagine themselves living, where, in some of those estates north of Perth, you can still walk to the beach. And these are some of the most beautiful beaches anywhere in the country. And if you look at some of the coastlines around Australia in relation to the proximity to our major capital cities, you're talking about multi-million-dollar homes. Yet you can still buy, for example, a new house and land package for $500,000 or $600,000 that's walking distance to a beautiful, one of the best beaches in the country, and still driving distance from Perth. So some of those factors do tend to come into play as well. But yeah, it's half a dozen one the other, because the purchase prices are similar, the yields are similar. It really comes down to personal choice when we're sitting there with the clients.
Adam's asking a question which I think is very much on trend in terms of one of the trends we see emerging. He's asking whether the influx of skilled migrants coming into Australia in the next few years, whether we're going to see an increase in demand for apartments, particularly rental demand in those inner city apartment markets.
Yeah. And I think the answer to that is absolutely yes. And it's not just from the international market, it's the local market now. And it's mainly driven by affordability. And I have to say to my clients, and look, we haven't in the past, we haven't been massive advocates for apartments, particularly not in high rises, right? So anywhere where you've got a lot of high rise development going on, we're very cautious and we don't tend to recommend that. Certainly apartments in smaller boutique blocks or sort of more medium density, particularly in some of the suburban locations, we definitely recommend. But apartments, you only have to look at all the major capital cities around the world, and what do people live in? They live in these high-rise apartments, particularly with these heavily populated areas. We can't afford to keep sprawling forever. It's just too costly. In terms of urban sprawl, and if you look at Melbourne, for example, we're like the 6th largest city in the world in terms of urban sprawl per capita. It's just too expensive. So we have to go up. And that's why we're seeing a lot more major construction on our roads and to intersections in terms of medium and high density coming through. So more and more people will just naturally become accustomed to living in apartments. I remember only 15 years ago here in Melbourne, you drive down South Bank or towards the city and there's no high rise apart from the city office blocks. And now there's high rise popping up everywhere. So people are becoming more accustomed to living in apartments. The reality is they can't afford to do anything else. Okay, so there's that option. And then obviously with migration, depending on where a lot of that migration is coming from, this is what those migrants would be used to also. And then of course, obviously you've got the student uptake there as well.
And Jenny's, excuse me, asking, what do you think about Southeast Queensland? Is it still worth investing there considering prices have increased significantly in the last 2 years?
Oh, look, I think that, look, this, and you can touch on this as well, there's still a lot happening, obviously, in Brisbane, and then you've got the Commonwealth Games to consider, the Olympics and things like that to consider as well. But there's options still available all over Australia. So as I mentioned before, I wouldn't just focus necessarily on one particular location. You know, have a look at all the different regions, maybe get some professional advice to decide sort of what price points you can sort of tackle as well. And then that might open up some other ideas. But I know that you've got a lot of comments there on Brisbane as well.
Look, I think Brisbane longer term is a great buy. It's the biggest beneficiary, excuse me, of population growth, internal migration from other parts of Australia. It's got a huge infrastructure spend underway. And now it's got that 10-year horizon created by the 2032 Olympics. Brisbane's dropped away in the first half of this year, not because of interest rates, because I think the major weather events that happened at the start of the year, which has dampened the market, no pun intended, a little bit. But I think Brisbane will resurge. It's got too many powerful factors in its favour not to do so. So I think looking across that 10-year horizon, Brisbane's going to be a great place to own real estate. Look, we've got more questions, but we're really out of time. We've gone a little bit over time, in fact. Look, I would urge anybody who has questions or would like to follow up and avail yourself of the availability of those free strategy sessions to make contact with Jason's team at AllianceCorp. Click on that link. We will be sending a recording of this event to everyone who's registered for it, and you'll be able to click on the link when you receive that email as well. But if you want, you've got further comments, further questions, your own situation to talk about, please follow up and make contact with AllianceCorp through the number on the screen or the link that's shown on the screen. Thank you, Jason, for a great presentation. I think it's timely because we do live in times when there's more media misinformation out there than ever before. And it's great to be able to have a research-based, calm, rational analysis of what's actually going on and what we can expect to happen with investment markets around Australia in the next little while. So thank you once again.
No, thank you for having me, Terry. And look, again, it's one of those topics that really gets under my skin because I see it firsthand. You know, I'll bump into people. They'll say, look, I'm going to put things on hold because of the market or what's being in the media. And then I come across them years later and they haven't done anything. They're kicking themselves or the wife's punching the husband, you know, and it's just devastating to see how much, you know, we're talking hundreds of thousands of dollars they've missed out on going towards their retirement plan or whatever, simply because of this media hype that skews people's opinion.
Yeah. Also point out to people regarding that book a free strategy session offer in both the Q&A panel and the chat box. The link is there, so you could also click there if you want to take action immediately and do something about that. So thank you again, Jason, for the presentation. Let's do it again soon. Thank you, everybody out there who watching and listening, for your participation, your interest, and your questions. I hope you found it useful, and we will be doing it again soon. But for now, bye from Terry Ryder at Hotspotting and Jason Paetow from AllianceCorp.
Okay, thanks.